pulled a Rabbi Block. I forgot to start recording this. So we're midway, and these have been our dividend yields and comparing to the 5-year treasuries, et cetera, over the years. In 1919, our dividend yield was almost double the 5-year treasury. Now we're at about 49% of the 5-year treasury. The S&P 500, our dividend yield is 2.25%. The S&P is 1.66%. And all the numbers I'm giving today are based on September 30th of this year. We like to see the dividend yield at 67% or greater than the 5-year treasury, but that's not the case now. So theoretically, we might have a slight overvaluation. Yet that's it's tough to have a dividend greater than 67% of the 5-year treasury, especially as treasury rates have increased dramatically this year. This is something I bring up every year, the rule of 72. Is anybody else hot in here? Is it hot? It's not. It's me. It's the heat of that. The rule of 72, it tells you how long it will take to double your portfolio. 72 is always a numerator, and then the denominator is either the interest rate or the rate of return or the number of years. So you can see here in 2014, the 3-month treasury was next to zero. It would have taken 7,200, or in 2008, 7,200 years to double. In 2014, 5,538 years to double. Now, at a 3-month treasury of 5.3%, it would take 14 years to double your money. 72 divided by 5.32 is about 14. I rounded. Interest rates on average, 3-month treasuries have been around. We're probably near the average 3-month treasury rate right now throughout history, as we'll see later in this slide presentation. Is everybody familiar with what a price-earnings ratio is? Anybody not familiar with price-earnings ratios? Don't be embarrassed. Yep. So a company, let's say a company is selling at $10 a share. That's the price on the exchange. And it earns $1 a share. 10 divided by 1, price divided by earnings is the PE ratio. So that would be 10. So when bond yields were 1% and a company was expected to grow at 10%, average annual growth rate, their PE ratio would be, well, this is based on someone named Benjamin Graham and David Dodd. I don't know, Tommy, are you familiar with them? Graham and Dodd? Grandfathers of value investing. And they came up with this matrix. So if a company grows at 10%, expected to grow at 10, with a 1% bond yield, they'd have a PE ratio of 125. If it's at 6%, the PE ratio goes to 20.9. There's no science in that, that's just an estimate. It may or may not happen. Meaning, so if a company earns $1 a share, it would be priced 125 times that, $125.40, with an interest rate of 1. Under the same scenario with the same growth rate, if the rates are 6%, it would be selling for $20.90. And that is what we've seen this year. We haven't seen it in the market, but we've seen interest rates go from near 0 to 5%. That's a huge increase. Here you can see money markets now, you can get 5.2%. A 5-year CD is even less than that, which is unusual. Normally you get paid for greater length of time. When we last put on our conference, the money market was 2%. The 5-year CD was higher than that at 2.76%. But many of you here remember, even now when you can get a CD at 5.25%, 5.5%, many of you remember 14%, 18% in the, I guess it was the early 80s, I don't recall. So interest rates have gone up dramatically. They've gone from near 0 to where they are now. And that's only in 9 months. Here you can see the history of the 3-month Treasury. So somewhere the 3-month Treasury has averaged 5 to 6% from 1934 onwards. And you can see here it was near 0, here it was near 0, and now it's way up to 5% again, 5.32%. Here's the period where it was over 15% on a 3-month Treasury. Hopefully we won't have that again. And that's when Paul Volcker was head of the Fed, and he wanted to fight inflation, and he did, and the rates came down. What you have here, as rates came down for 40 years, you had a great bond market, a bull market. Are we now in a bear market of bonds? I remember my aunt had CDs come due, and she was so upset she was going to have to reinvest them at such a low rate of 6.5%. It's true, and you know, it was a low rate back then. It was, if she was alive today, well, she was alive 2 years ago, she'd see the difference. Same thing for the 10-year Treasury. 10 years average 7%, and now is 4.6%. So you can get a 3-month Treasury for 5.2-ish% or 5.3. Normally, if you go, now that could be a temporary number, as eventually I would think that the 30-year Treasury is going to be much more pay up much higher interest than a 3-month Treasury, but right now it isn't. The 30-year Treasury now is 4.7%, and the 5-year Treasury is 4.72. So you're not getting paid for that length of time, but it is what it is. You can see also how mortgage rates have gone up. Mortgage rates were what, near 3%, and now they're touching 8%. That might prove difficult for housing. You get a lot less house for the same mortgage you take out, or for your monthly payment, you're going to get a lot less house than you did 4 months ago, 5, 6 months ago, maybe a touch longer. These are, and you could see on I forget what page it's on. On page 22, you can see, page 22 and 23, you can see all our holdings in largest position first order. when you look at our long positions only, here's our breakup, and it's been pretty similar to this for many years. There's been some, well, with U.S. Treasuries at 25%, once again, they're in ETFs, not U.S. Treasuries. They're only investing in U.S. Treasuries, nothing else. We have a 25% allocation. That's, our IRAs, once again, have a 30% allocation, and our regular accounts have a little less. I'll explain that afterwards. We try to put a defensive nature into both types of portfolios. So you can see technology and how we have it broken up. As you know, we've been invested in cannabis for quite some time, and a very small investment in it now. We did have a large position in Scott's Miracle-Gro, and we did get rid of that, and luckily we got rid of it way before it crashed. Our clients know that we had a large position in Gazprom, the largest oil and gas company in the world, Russian-owned. And we wish we never owned it. We had at one point, at our last conference, it was a 15% position. Before it became untradeable, it was near a 12% position at the end of 2021. I'm sorry we owned it, but we owned it. I didn't anticipate any of what's happened, but it happened. It was I thought it was such a great investment. It had a 7% dividend. It made a lot of money, but the world perceived it as Russia is bad, and I should have perceived the same. But I know I'm not the only one in that basket, but I wish we didn't own it. Now, it's trading at it's trading zero. We're not allowed to trade it. We're not allowed to buy or sell it. There's no market. It is selling it's selling on the Moscow exchange. It's selling on many exchanges, and its current value would be about $3.50 a share. I do think one day we'll get a big bonus there. I think $3.50 share is way depressed, and maybe we'll get, maybe, or maybe not, and it could take many years, $7 to $10 a share. Who knows? Maybe more. I used to think it would be worth $20 a share. It's interesting because I was telling some friends of mine, old friends and clients, how I had bought gold in 1992 and hit it, and then an ounce and a half of gold, I hit it, and then I lost it for about 8 years or so. I don't remember how, and one day I was cleaning up and I found it. I was so happy. And hopefully that's it. For the first time I thought, maybe that's Gazprom. Maybe I do believe that one day something will mend in Russia. Either Putin will be replaced, something will happen, the West will come together again with them, and if that's the case, there'll be value. If it's not the case, we're already at zero. Can't get any worse. I think that's really all I have to say. I would like to answer questions, and most of this, my ideal scenario for our event is to answer clients or friends' questions. So let's leave it at that. And if you want, I could discuss a few of our holdings, but I'm going to leave it open to questions.
Could you help us a little with Brookfield Asset Management? I know at one point we were looking at Brookfield. They were a big owner of malls, and they were big owners of commercial lease properties. And I see them floating around. Just give us your thoughts on Brookfield.
James wanted to know about Brookfield Asset Management, which also now involves Brookfield Corporation. Brookfield Asset Management is, and you're not going to see it, well, you'll see it as our short position. And if you're in an IRA, you cannot have shorts in an IRA. It has not been a successful investment for us, but I do like the hedge. I feel like I have this part of this. I do like the hedge of of the short positions. Brookfield Asset Management at this point is a asset manager. They're a private equity company, and they invest in a slew of infrastructure and energy, dams, malls, like you say. Well, really not malls, but because that's Brookfield Corporation, the real estate division. But they basically are an investment manager. Brookfield Corporation, which spun off from Brookfield Asset Management, I think it was this year, I'm trying to remember, I think it is. They are the company that owns all the real estate. They also own 75% of Brookfield Asset Management. Brookfield Asset Management is I just feel it's overvalued. I don't feel any, like, they don't have debt anymore because they spun it all off to Brookfield Corporation. And we probably won't have that for a long period of time, Brookfield Asset Management, because they're a pure play. Brookfield Corporation, which is a spin-off, they own a lot of real estate, but they also have a lot of debt, and a lot of the real estate in Class A properties, a lot of them, some of them are in distress. They're not paying all their mortgages, but they claim it's only a little bit of the mortgages they're not paying on some major properties in Los Angeles, San Francisco. And our thesis there is that that their liabilities are much greater than their assets, and one day that will crash. In the meantime, it's about, if I remember correctly, the two together are about 9%, a 9% portfolio position. So it just like the treasuries produce a hedge for our IRAs, because there's always something, it'll retain value no matter what, unless the U.S. goes under, and then we're all in big trouble. The shorts, the Brookfield Asset Management and Brookfield Corporation, give a hedge against the portfolio if things were to get difficult in the world. And I think the Brookfield Corporation assets are going to have great difficulty, especially with rising interest rates, especially as their debt starts coming due. A lot of debt is with them, and a lot of other companies are what's called covenant light. So if things, in old times, if things started going bad, their debt would be in default. But right now, there's very light covenants until they have to refinance, which prevents creditors from coming in and demanding greater payments, more equity, more cash. So that's our thesis there. I'll tell you, that's about 8%, give or take a few percent, of our portfolio. Our big short positions are in high yield bonds. And it's so interesting. It's so interesting that high yield bonds are up this year around 5%. Interest rates have gone through the roof. A 7 to 10 year treasury fund is typically down about 4%, and that includes the interest they pay. So why would in distressed times, in high interest rate times, it doesn't make sense to me that junk bonds or high yield bonds are doing so well and U.S. treasuries are not. Our thesis is that things will change. I think right now there's a a lot of the bond funds are selling, they're selling high yield bonds to other funds, they're buying funds from other funds. They're not doing it unscrupulously at all. There's just a lot of liquidity out there. When and if that liquidity changes, prices could start to deteriorate. And at that point, we would cover our short position. I would cover the short position now, but then our portfolios, our taxable portfolios, one, we would have to, they would lose our hedge, we would lose our hedges. We have enough money to cover buying back the short shares. But then we would have a 100% stock portfolio where IRAs have, let's say, a 70% stock portfolio, and I'm rounding. So to create another 30% of cash to buy treasuries in a portfolio, we would probably have taxable events, and I'm trying to avoid that. Well, that's where that is. We have seen the last few months, the high yield funds have been decreasing in price, but not by a great amount. And it's still unusual to me that HYG is something we're short, is up 5%, I'm rounding this year, whereas treasuries are down, basically almost the inverse of that. Does that answer your question, Jim?
And just a follow-up to that is BABA. I know that when we started looking at just the international scene right now and tension and relations between China, U.S., and some of the other countries out there, do you see anything that's on the horizon that could be stormy weather because of the issues with China right now?
Jim asked a great question on our investment in Alibaba. And if the current geopolitical environment and China, what could happen out of that? Is that what you're asking?
Basically that's it, right?
And I'm not being a wise guy, and I hope it doesn't turn into a Gazprom. The only difference would be is we have about a 6% position in Alibaba versus we had upwards of a 15% in Gazprom. Alibaba is the largest e-commerce company in the world, as measured by gross merchandise volume. They're bigger than Amazon, and they're just like an Amazon, but in China. They have big cloud units, and our average, we bought it as high as, the stock was as high as $319 in 2020. Today it closed at 84, and for many of our accounts, if not all of them, we bought as low as 61. Our average price, you'd have to look on page 622, is probably around $96 a share, something like that. When they were priced at $300 a share in 2020, their price earnings ratio, which I explained before, was over 20. Well, now it's under 10. We project, for Alibaba, we project earnings for $10.50 this year and $11.50 next year. That would be next year's PE would be 7.3 times. What's very interesting is since 2020, and even before, since 2018, they've brought back a lot of their shares. So there's less shares on the market, so that means their book value has gone up. Their earnings, their revenues have all gone way up over the years. So they're not in distress, but China, we know, is having difficulties right now in their own economy, although their own economy having difficulties is less growth than it used to be. But some question that number, maybe they are contracting. I think if China wakes up and if China's economy starts doing better, if things improve in the world, if the situation with Taiwan gets pushed aside, we could once again see it. If they had a PE of 20 now, then it would be a $230 stock or so forth. So I think it's a great investment in the future. My gosh, as I say this, I said it about Gazprom. Gazprom still could work out, but I think it's going to be a very good company for us to own. When will that happen? Who the heck knows? And it doesn't matter, because many of you have been with us, and I wish we still owned it. We bought Walmart under the same conditions. We bought Microsoft under the same conditions. They were dogs for years. We owned them. They didn't do well, and then they skyrocketed. Unfortunately, we sold them both. And as I get older, I learn trying not to sell the companies we own. Some companies will sell in the IRA, but not in your taxable accounts. A good example is Meta, which is Facebook, their new name. Meta we bought, I forget the price, it cost us about $89, and now it's, oh gosh, what's it? Now it's 321. The reason we're not selling in our taxable accounts is we would have a huge gain, a short-term capital gain, which is very unpreferential rates. So if we had the opportunity to trim it down, we would. It's interesting because our short positions in our taxable accounts should lend to, because the shorts have not done well this year, should lend itself to much less performance in our IRAs, but it hasn't, and that's because a lot of the companies we've sold in our IRAs to create defensiveness, we haven't in our regular portfolios because we have defensive positions built in, and we don't want to pay short-term capital gains. We would much rather have long-term capital gains with that. If the price doesn't drop, and if we have to hold it another, I forget when we bought it, probably the first or second quarter of 2024. And then we'll do tax loss selling over the next few months and try to be tax efficient in our portfolios. Does that answer your question, James?
And just one final one.
No, keep them coming.
Not to be a pain.
You're not a pain. Keep them coming. We're here till 10.
Last one, I promise. Energy. Recently, you've seen the CEOs of the big energy companies, the Exxon, the Shells, the BPs, are changing their philosophy about moving away from fossil, and now realizing that in the next moderate term, 5 to 10 years, that energy, fossil fuels, gasoline, diesel fuel, jet fuel, are all going to be critical ingredients. And I know that we hold some nice, I call them stalwarts that are out there. We have ExxonMobil, we have Chevron, and those. Do we intend on looking to hold on to those as they go into, I would say the next generation? Exxon just made a huge purchase of Pioneer last week for the Permian Basin out there. And all of a sudden, I think the investment community came along with that because you saw the shares going up and up. Just like your thoughts on energy from that perspective, Ron.
Well, the world would like to be off of oil. I forget, 2050, I think it is, or 2035. It's not one. But we're seeing, and Exxon many years ago bought XTO, if you remember, a natural gas company. Exxon's the biggest natural gas producer in America. I believe that Gazprom is bigger, but they have a carbonless future for sure, and we certainly need fossil fuels for now. But not only are they the largest, Chevron and ExxonMobil, not only are they very large oil companies, but they're also very large gas companies. They're also spending a great amount of investments in hydrogen and a carbonless future. Let's see where that takes off to. But I envision that those are two staples in our portfolio that might be there for a very long time. That's my guess. You never know. Even with the huge drop of oil prices, although they've gone up, they're going up and down, Exxon and Chevron both carry very low, historically low price earnings ratios of in the 13 range. So there is a margin of safety. They both have, Exxon has a 3.5% dividend and Chevron has almost a 4% dividend. So I think they'll be within our portfolios for quite a long time. We also own NRG Energy and National Fuel Gas, which natural gas will be needed. They power utility companies. We own Panasonic, which is a big battery maker for electric transportation. So we're pretty diversified there. We always try to stay diversified. It's only 7% of the portfolio. I'd love for it to be higher, but at this point it's not. Anybody else? Steve?
Question about pharma and the implications on the pharma sector specific to the Medicare negotiations that are taking place. Do you see that you want to maybe pull back on your allocation there, or what are the overall implications for pharma specific to the Medicare negotiations?
We've had the government involved in pharma for our whole careers, no? Is that right? Or it's getting a little more now. I don't see it as a long-term detriment at all. We're pretty diversified in our pharma. We have OPCO, which is hasn't done well for years. They're the third largest lab, behind Quest and LabCorp in America. We have Teva Pharmaceuticals, which is Israeli, from Tel Aviv, Israel, which is a largest generic manufacturer in the world. We also have Merck and Pfizer. So sure, there'll always be ups and downs, and Pfizer's stock has not done well this year. Well, all healthcare hasn't done well, but the industry's there for the future. We need pharma for the future. We need them for all our drugs. And you're in that industry, right? Yes. And how do you see it?
Well, just from conversations that I've had with people, they see pharma tapping the brakes on certain expenditures.
Well, Pfizer just announced it the last day or two.
Industry, right?
Yeah, but they're going to be around a long time, and they're So Teva's a small company, and they do $4.2 billion a quarter. So yeah, there'll be short-term effects. But they'll be around. That's my thought. And they're all. To give an example, the credit rating agencies give Merck, they're high. They're a very high investment grade credit. Pfizer as well. So I just don't see. Sure, their short-term profits could be affected, without a doubt. But we are long-term investors, so we really care about. We have a roadmap in all our investments. We try to see what is it going to be like in 10 to 15 years. That's almost impossible to see. Sometimes it works, sometimes it doesn't. But it is a roadmap, and the roadmap gets adjusted. our directions get adjusted if there's traffic, but I don't see it with any of these major farmers.
Because historically, farmer gets nervous at election years, and farmer now gets nervous with Medicare negotiations.
Sure.
And that's kind of an unusual convergence.
Yeah, we'll see what happens. Hence our large position to treasuries and defensive natures. That's that. Yes, Kurt.
With the, do you ever look, do you feel you've missed out on a particular area? I didn't see any stocks related to, if you look at a macroeconomic view of the world and kind of dictatorships and the personalities we have in these countries that, like Putin currently, who are not easily understanding of the way the world should run today. Have you thought you've missed out in perhaps investing in some, the military stocks, the Boeing, the weapons, you know what I mean? Because we're sending a lot over there, right?
Mm-hmm.
And I can't imagine those stocks are not twice what they're beating the S&P, I would think.
I don't know, but you're very well possible. It's interesting. Do I feel I missed out in military, not investing in military, or
they're part of technology too.
yeah.
You know.
No, I never thought about it till now, to be honest. We can't own everything. We did own Raytheon for a period of time years back. No, we can't. We're gonna miss out on a lot of things, and we'll do okay in a lot of things. But no, I don't feel it. I should look closer, but I haven't looked there. No. Yes, Jeff.
I have a question about Intel. Intel, I see it's high up.
Yes.
on the list. What's your feeling about Intel?
Intel's getting rid, not including cash and treasuries. It's our second largest position. Now, part of that has been a recent run up from, if I remember correctly, 29 to close today, just under 36. Also a high grade credit. Used to be a lot higher. They did very well through COVID as everybody was working at home, buying PCs and so forth, but that hit a wall. They had competition from NVIDIA and Advanced Micro. Now they're spending a lot on capital expenditures. They're taking write-downs. Their debt has increased because of their capital expenditures. They're trying to expand certain operations and become a world leader again. Our thoughts are we're not selling it. We did pare it down quite a bit, especially in our IRA accounts this year. I'd have to look at my notes to see when that was. But I envision that to be a core holding for a very long time in our portfolios. We produce, if you go to our website, we do an annual presentation, and it tells you how long we've owned a company, and that's probably been one we've owned for quite a bit. I'm not buying it at these levels, but frankly, we're not buying a lot of things at these levels other than treasuries, new clients. I would like the market to increase a little bit before we even establish short positions. But Intel's a core holding, and I don't see that going away. Well, the same thing as Exxon. Really, a lot of our holdings are, I think, potentially permanent holdings. Does that answer you, Jeff? James, please hit more. Any other questions? Well, this is a quick one. Let me talk about a few of the other companies we own. We own a company called Kyndryl Holdings. They're a spin-off of from IBM. They're the largest supplier of IT infrastructure globally, in both services and they really get clouds going and clouds working and so forth. they're an interesting scenario. They lost $6 per share last year. It was totally expected. They did a little bit better. They're doing a little bit better this year than expected. And at some point they'll break even in the next, probably not next year, but the year after. What's very interesting with them is they're showing a net operating loss, meaning each share they might, I'll be more exact. They lost 62 cents a share last quarter. But if you add back there, or last, excuse me, I'll refer to my notes. They lost $6 a share last year. When you add back their non-cash items, depreciation and amortization, that's non-cash. They paid for it. It doesn't matter if you lost money or not. When you add back the cash, when you take the net loss, add back the depreciation and amortization, and then subtract their expected capex, their free cash flow would be just under $3.60 a share. I think that Wall Street is not. They're very underfollowed. A lot of spin-offs are because of complexity. They used to be with IBM, as I said. I think they're under-researched, and one day the world will see that and the price will adjust. So they're selling for about 4 or 5 times free cash flow. That's a very inexpensive number. So let's see what happens, especially when I can't imagine they won't be profitable in 2025, possibly in 24, but in 2025. There's another company we're looking at that I'd like to own, but just waiting. Hopefully we don't miss it. I don't think we will in this market. And I won't mention the name, but a similar type of situation. We own Ford, which is also a credit that's not even investment grade, non-investment grade by the credit rating agencies, but they have been put on outlook positive, so there's a potential upgrade coming up. Very often, if they're on positive, upgrades happen. If they're negative, downgrades happen. And it's a form of an upgrade, but it's not an official upgrade. Where, let's say it goes from, well, they're rated BB plus. Which is non-investment grade. So if they get, but they're on positive watch. If they get upgraded, boom, they're investment grade. Now, in a market that's healthy, that's really good. Now, you could stay at poor prices for a while. On the other hand, their dividend, which they just today announced, maintaining it, is 4.5 to 5%. Another company we own, which is our 10th largest holding, is Nokia, which is formerly Lucent. Nokia is a huge telecom infrastructure. They run the internet and so forth. Well, 5G doesn't go through them, goes through them, Ericsson, etc. They've had a drop of revenues this year, but that's industry related and not company specific. And a lot of that is customers in North America have tightened their belts and have stopped expanding, and 5G spending is a little weaker. But that's a company we own, but also most of our companies are high investment grade, are very strong financially. A few are not investment grade, and that would be Nokia would be one of them. Well, they are investment grade. Let me just see. they're the lowest tier of lower medium investment grade. And so we have diversity there. And they're part of our technology portfolio, which is 23%. Yes, Alan?
Would you consider looking at any companies involved in AI development?
What's AI? Well, every year you say, I'm your partner, softballs. Yeah, of course. And a lot of our companies are in AI. At Meta, one of the largest AI companies in the world, right? Intel. I would think all our technology companies are AI related. Just trying to look at this. Alibaba, for sure. Alibaba today just announced a big investment with other groups in China in AI. Intel, Kyndryl, we're heavily invested in AI. If AI did not pan out, they're very diversified. But we're not in any AI pure plays. They're pretty darn close. Meta's as close as you get, I guess. But Meta's a small position. Overall, it's a a 1.5% to 2% position. But once again, our IRAs have less and our taxable accounts have more. So it's a much bigger position in our taxable accounts. But if there was no tax system, or if we had a lot of losses to work off, we would own less Meta. Okay. Other questions? Yes, Andy.
I remember one word you haven't mentioned today is value stocks, right? That used to be kind of the whole thesis, right?
Yes, I'm sorry I didn't mention that because
Last year it worked out all right? Because last year was good.
well, last year worked out, but you can't go year by year. Value has been, except for last year, value has been out of play for 10 years. I should have mentioned it because all of our investments are you finished asking? I'm sorry.
Yeah, so
Oh.
is that still kind of the
yeah.
bread and butter idea?
Yeah. Andy asked about, he thought maybe I swayed from value investing because that's been our theme. That's been our theme since we started. We started in 1995, but reporting our numbers to regulators since 1997. That's been our theme since the beginning, and it hasn't changed. I should have mentioned it. We are value investors. Value means, well, value is so broad. There's no real meaning to value, but we try to buy companies that their price-earnings ratios are low to the industry, healthy companies, and where the PE ratio is less than their return on equity or return on capital. And that's either net income over equity or net income over, also taking into account debt. So there is no doubt that we are a value portfolio. I just didn't mention it. It's probably in the handout, but nothing has changed. And I more so than the last few years, never say never, but I can't imagine that I would ever be anything but a value investor. You never know, but it's my structure is value investing. I mean, I like buying. Well, like Kim knows, except for my suits and ties, I like buying things on sale. Well, I like buying my suits and ties, and I never wear either anymore. But buy them on sales too, but they're certainly not sale price. These shoes, Kim yelled at me when I bought them because I paid like maybe 3 or 4 times what you would pay at Florsheim at the time, and Kim got very angry with me. I'm like, I'll own these forever. And that was 30 years ago. I no joke, I have 3 pairs from Brooks Brothers, and I remember, I don't know if you remember this, but getting sternly yelled at, but I was buying a pair of shoes from Florsheim every year. And I got a cut in one of my leather shoes, one of my Brooks Brothers shoes a few years ago, and I brought it to the shoemaker. I go, he can't fix it. I go, I should dump it? He's like, no, look at this shoe. No one can even tell. Just, you get it resold. So I'm a value investor. plain and simple. Even, let's see if we find, I'll try to find a stock that we own that's not a value investment. And we do have some of them. Kronos Group, 2.5% of our portfolio, because it's a cannabis company. That is not necessarily a value investment. Meta is not a value investment. I can't see any others. So maybe 4 or 5% of our portfolio is sways from value. That's how I see it. But value is so subjective. It's a tough word to put a formal definition on. But yes, we're value investors. Other questions? None? No difficult?
Just ask you one final.
Oh, please, keep them going.
In your mind, what do you think the Fed's gonna do in the middle of November? Where, from all your analysis, all your research, and what you talk to your comrades about, what's the Fed gonna do with this?
I will revert. James asked what I think the Fed will do in November. And there's so many thoughts out there. I remember hearing Alan Greenspan say, and a very smart man, unarguable. You may like him or not, but he is and was in his prime, a very smart guy, still smart, right? So he always said, you can't predict interest rates. You just can't predict them. Who knew interest rates would go who knew this would happen? Going to near zero for a period of years because of the financial crisis, because of COVID. Who ever thought that in 2021, the rate was near zero, and now it's over 5. No one could imagine that type of increase so quickly. So I don't know. I just don't know. And it's not that I don't think about it, it's not that I don't pay attention to it, but who the heck knows? I guess, and there's so many scenarios, I wouldn't even guess at it. Maybe they'll think, and the common thought is, rates have adjusted, as we saw mortgage rates, have adjusted on their own without the Fed. So maybe they've adjusted and maybe they'll just keep a tight economic policy, tight monetary policy. But I don't know. They still could raise rates. It all depends on the economy. It all depends on inflation. Look, the economy is very strong. Today, some of the banks reported, and the consumer's getting a little weak, but it's still pretty darn strong. Housing is at a terrible low right now, probably because of interest rates. And there's something I forgot to mention. There was a man, I've talked about him for years, Marty's Wide, who passed away many years ago. He had a saying, "Don't fight the Fed." And that's on my whiteboard in my office. Don't fight the Fed, meaning if the Fed starts raising rates, be careful of the stock market. Right a few months before Marty died, I talked to him on that. I'm like, rates are going up. And, they went from, let's say, 4%, maybe in this period, I don't remember when he passed. But he said, if rates aren't at 6%, you could avoid, don't even listen to the don't fight the Fed argument. Although that was the first time in his career he ever saw low rates. But it has me worried. Rates going up has me worried. What the Fed will do, we don't know. I trust the Fed. I think they're very competent. So I'm sorry I can't answer that question. It's not because I'm not knowledgeable. I will never be able to answer that question. Others? Anybody else? That's it. Well, thank you all for attending. Please hang out, have a drink, ask questions. Thank you very much.